Welcome to everyone behind their screens. My name is Florian Heider. I'm the Scientific Director of the Leibniz Institute for Financial Research, SAFE. And with me are Glenn Schepens and Christoph Kaufmann from the ECB to present highlights from the most recent edition of the ECB's Financial Stability Review. It came out in May. You can read the full report online. It's far too big to present in an hour. And so what we usually do here is we present particular features more in depth than what one usually take notice of if one looks at the financial stability report in full. And I'm very happy to have Glenn and Christoph here because they're going to provide insights in something that is on a lot of people's minds, which is the non-bank financial sector and whether we should worry about it or not. Before I give the floor to Glenn, housekeeping is that if you have any questions, please put them in the Q&A. I will monitor the Q&A, and I propose to go over your questions at the end after Christoph and Glenn have done their presentations, unless I see it's an urgent question or need some clarification of something they said, then both have agreed it's fine to also interrupt, but I will carefully monitor that. And with this, welcome Glenn, welcome Christoph, and the floor is yours.
Okay, great. So thanks a lot for the invitation. So I will be talking about a special feature from the recent Financial Stability Report that focuses on stress in global private credit markets. So, and to be clear from the very beginning, so when we're talking about private credit in this special feature, what we mean is direct lending by private credit funds, so non-bank type of non-bank financial institutions to non-financial companies. And these private credit markets, they've been growing rapidly in the euro area over the past 10, 15 years, just like they did in other parts of the world. So for example, if you look at annualized growth rates in this left-hand side graph here for the euro area, they annualized growth rate averaged around 15% during this period. Now, notwithstanding this significant growth, overall total market size of private credit in the euro area remains relatively small. So depending on the source you look at, you get market estimates of around 100 to 200 billion euro. So compare that, for example, to bank lending in the euro area with bank lending to non-financial companies, which stands at around 5 trillion. But also when you compare it to private credit in the US, the euro area numbers are relatively small, given that these US numbers are rather around 1.1 to 1.4 trillion dollar, again, depending on the source that you look at. Now, another salient feature, I would say, of these private credit loans is that they're typically going to relatively risky firms. So this right-hand side chart on the slide, for example, shows the share of euro area firms with interest coverage ratios below 1. So for private credit borrowers, this applies for around 30 to 40% of their borrowers over the past couple of years, while for bank loans, it's more, it's hovering around 12, 13% during this period. So relatively risky loans. Just to give you a bit of a couple of stylized facts about private credit in the euro area. Now, recently, there's been increased attention to this private credit market. So they came under scrutiny from investors and policymakers. And this had mainly to do with recent turmoil in US markets. Now, these US markets, they consist of, say, in general, two types of important private credit providers. So on the one hand, you have the traditional private credit funds, which tend to cater to institutional investors, which tend to be closed-end funds. And which make up around 60 to 70% of the market. On the other hand, you have the business development companies, the BDCs. They have around 35% of the private credit market. And it's mainly these BDCs that have been in the news. It's also these BDCs that you often read about in more academic papers. And the main reason for that is these are the only private credit players out there on which we actually have good data, because they need to file at the SEC. So there's two types of these business development companies. There's the unlisted and unlisted BDCs. And these unlisted BDCs, they are typically semi-liquid private credit funds, meaning that every quarter investors can ask their money back. But at the same time, importantly, these funds, these BDCs can decide to limit these payouts at 5% of their net asset value. So, and at these BDCs, we've seen a strong increase in redemption requests in the last quarter of 25 and the first quarter of 26, as you can see in the left-hand side graph here. So redemption requests averaged around 1 to 2% before, and in these two quarters, they jumped up to 10 to 12% in the aggregate. Now, the main reason for these large redemption requests was some panic about software exposures of these BDCs. So a lot of these business development companies, a lot of the credit they provide go to software companies. And due to the so-called software apocalypse, this fear that and some of these software companies might become redundant due to recent advances in AI, we saw this fear about these exposures of these BDCs to these software companies, and hence these large redemption requests. Similarly, for listed BDCs, we subsequently saw strong drops in their stock prices, as you can see on the red line here in the right-hand side graph on the slide. Now, given this recent turmoil, one of the things that we started thinking about within this special feature was exposure of euro area financial institutions to private credit worldwide, and potential consequences of stress episodes for European financial institutions. Now, first important thing to note there is that if you look at direct exposures of euro area financial institutions, such as banks, insurance companies, and pension funds, is that these exposures tend to be relatively limited in the aggregate, relatively small, although they are concentrated in a few large players. So if we look at aggregate exposures, for example, to private credit, then we see for banks, estimated exposures are only around 60 to 70 billion euro. For insurance companies, it's a bit higher at 200 billion euro, but still relatively limited in size. So for comparison, for example, if you compare this with exposures of banks, for example, to leveraged loans, a closely correlated credit category, then you can see that these exposures to leveraged loans for banks are an order of magnitude larger, standing at around 500 billion euro. Now, with this in mind, a substantial part of the special feature we spent on trying to develop scenarios of a shock to global private credit markets and analyzing what the impact of such a shock would be. And for this, we proceed in three different stages. So in the first stage, we model an isolated crash in private credit markets. So we assume large defaults in their software exposures, so 30% of software loan default rate in their portfolios, and a 10% default rate in the other parts of their portfolio. But again, this only contained to private credit markets. In the second stage, we add losses in closely correlated markets, such as leveraged loan markets and high-yield bond markets. So the idea being that in an event where there are these large software defaults, this will also affect other credit providers, other types of credit markets, and the ones most closely related to private credit here would then be leveraged loan markets and high-yield bond markets. And then in a third stage, we look at a tail risk scenario. So we look at an environment where there's a global reassessment of risky asset valuations, with, for example, global equity price declines of 30%. So this is close to what we've seen during the COVID crisis episode. So this is a very extreme scenario, and there's two ways of looking at this. One is that it gives you an idea of what would happen in case these private credit losses occur during a period of a global, say, negative sentiment in markets, very negative sentiment. Another way of looking at this is seeing this as a sort of benchmark scenario that allows you to compare stage 1 and stage 2 with a very extreme tail risk type of scenario. And ultimately, what we want to do is try to analyze what the impact of this would be of these scenarios would be on euro area financial institutions. If we then look at the first scenario, so the contained crash in private credit markets, then we see that a severe shock for euro area financial institutions. So direct losses for banks, for example, would be limited to around 200 million euro in our scenario. So very relatively small losses there, and this should really surprise you given the low exposures of these financial institutions that I documented 2 slides ago. Now, if you then add these other stages, these direct losses from leveraged loans and high yield bonds with the yellow bars, and the stage 3 losses with the blue bars, then these losses do become somewhat larger. Especially, for example, leveraged loans will especially affect the banking sector here, again because of it's the sector that's most exposed to leveraged loans, while insurance corporation and pension funds would particularly feel these valuation losses from equity price reactions. But overall, the main takeaway of this whole scenario analysis is that private credit in isolation is rather unlikely to lead to a financial crisis, even when stressing these correlated asset classes simultaneously in stage 2. But of course, once you get this broader adverse market revaluations, these are scenarios that would be have a slightly larger impact, but overall still fairly contained. Then finally, a last exercise we do in this special feature is make this more qualitative comparison between private credit markets and US subprime mortgage markets back in 2006, given that this is a comparison that shows up relatively often in newspaper articles and so on. And overall, our main takeaway here is that while there are some similarities in terms of these being relatively opaque markets and credit quality being relatively low, there's also substantial differences which make us to conclude that private credit is not really a subprime redux. Important differences, for example, are relatively low leverage typically of these private credit funds compared to entities that were providing subprime credit. For example, if you look at the US debt to asset ratios of these private credit funds, typically only stand at 30 to 50%. Also, if you look at size of these markets relative to GDP, private credit markets, even in the US, are still an order of magnitude smaller than subprime markets were. And from the European perspective, if you look at exposure, for example, of European banks, as we showed a couple of slides, as we've seen a couple of slides ago, this tends to be relatively low when it comes to exposure to private credit. So with that, let me conclude with kind of main takeaways of this special feature. So first of all, while we see that private credit is growing rapidly in the euro area, it's still relatively small, and exposures of euro area financial institutions are also fairly limited, implying that private credit turmoil in isolation is unlikely to threaten financial stability in the euro area at present. But of course, given that it's so a quickly growing type of credit, it's definitely there's a need to monitor it closely and continuously. And then finally, risks. I think it's also important to mention that at the same time, there's also potential benefits, of course, of private credit and developments in private credit markets, given that they can help to advance the EU saving and investment union agenda. If we want growth, more growth in the euro area, if we want to support innovative firms in the euro area, someone will need to provide the risk capital for that. And from that perspective, private credit markets might be very helpful. So let me leave it at that for this part on private credit markets, and go to Christoph for his part on this financial stability box.
Thanks, Glenn. Thanks a lot. And now over to Christoph, who's looking at a related but different question on market valuations.
Exactly. Thank you very much also from my side for the introduction and the invitation to this event. Yeah, so what this is about is drivers of investor behavior in highly valued equity markets. And what we're really doing here is a deep dive into what investors, which type of investors, and out of which reasons or motivation are active in stock markets, in particular those segments that have particularly high valuations these days, like US technology values, for example. And with this, we can go to the first slide. Thank you. So to set the scene for this a little bit, and I guess this is pretty well known for most people, we can look at this chart on the left-hand side, which shows you price earnings ratios of selected stock indices in the US and in Europe as a overvaluation metric, basically. And we're showing here in particular the Stocks Europe 600, the S&P 500, so two very broad indices, and then also the Nasdaq 100, capturing more technology stocks. And we can clearly see that over this time span, over the last 10, 11 years, these stock valuations have been risen, and in particular in the US and even more so in the technology segment, these valuations seem to be unusually high compared to historical standards. And against this background, we can then look on the right-hand side who in the euro area is actually holding these stocks that are behind this expansion on the stock markets. And in the left panel on the right-hand side, we show you the exposure of euro area investors to all equities globally. And on the right panel of the right chart, we do a deep dive into US equities. And this is again over a time period of the last 10 years. And when it comes to overall volumes of the exposure, you can see that for all equities, the exposure of the euro area has roughly doubled over these 10 years, from something like 6 trillion to more than 12 trillion. When you look at the exposure towards the US and US equities, this has even quadrupled from 1 to 4 trillion, so much higher rate of expansion. And this is, of course, driven on the one hand by strong investor inflows, people pouring further money into the stock market, but on the other hand, of course, also driven by the strong valuation gains that are also reflected in this chart on the left. When you then look at the composition of the investors who are behind, what stands out on both parts, global equities and US equities, is the dark blue area reflecting investment funds that are holding the lion's share of these equity exposures. In light blue, you see direct exposures from the household sectors, and then to smaller extents, also insurance corporations and pension funds have direct equity exposures. Important to note here is that insurers and pension funds and households may also have much larger exposures, but these are then indirectly done through the investment fund sector. But the important takeaway here is, if we want to understand a bit better what is happening on the stock markets and the investors behind, we have to look at these investment funds. And this is also what we're doing then in this analysis on the next slide, where we use an empirical estimation model to assess different driving factors of investor behavior. And we look in particular at investment fund flows, so flows of investors into different types of investment fund categories, namely flows into European equities, into US equities, and US technology equities. And these investment funds are always domiciled in the euro area, which is a proxy also for the domicile of the ultimate investor, even though not one-to-one. And we are then estimating models where we have as explaining variables, we have interest rate levels in the US and in Europe. We have stock markets in US and Europe and the exchange rate. And then using so-called sign restrictions, we can decompose different driving factors. And this will be monetary policy developments in both regions, macro developments in a broad sense in both regions. And this will also include in the US case, in particular, this AI boom and all these expectations and investments around AI that we're currently seeing also so prominently in the news. And finally, we also have a measure for the global risk sentiment that to some extent will also capture geopolitical environments, for example. And using this setup, what we're doing then on the left-hand side is we analyze how sensitive are investor flows to these 5 different factors. And what stands out is, first of all, that in response to a monetary tightening in Europe and in the US, visible on the left-hand side of the chart, you would see significant outflows from these investment fund categories. Instead, in case of positive macro news or macro developments or positive global risk sentiment, you would usually see inflows to the investment fund sector. On top of that, you can also see that the bars have different length, and that in particular for the red bars reflecting US tech equities, the bars are particularly strong. This means that the sensitivity of investor flows into these stock market categories are particularly high. And this also means in turn, or the flip side to that, is that these funds are particularly vulnerable to sudden flow reversals in case of any adverse environments in these factors. And having established these driving forces and also the relative size of that, we look now on the right-hand side into historical driving forces for investor flows coming from European investors into US equities. And this is depicted in the black line on the right-hand side. And then the shaded areas show you the relative driving forces through the lens of the model. The main 2 factors driving the inflows here seem to be the light blue and the dark red. The light blue reflecting the US macro factors, which, as I mentioned earlier, very much also includes the AI-related boom that we're currently seeing. While global risk sentiment is a downward dragging force on investor flows, reflecting the challenging geopolitical environment also over the last couple of years. At the same time, you see that monetary factors and also the European macro factor has some effect, but it's not a particularly important driving force in the last few years. And with this, we can go already to the next and concluding slide on this. So what do we take away from this analysis? The first is, as already mentioned, due to this high sensitivity of investors, in particular in the tech stocks, that these investor flows and as a consequence also asset price valuations could revert quite quickly. So in particular, I think the most plausible cases we can think of is that if AI adoption or the productivity gains that people have in mind related to AI fall below expectations, or if we see a further strong deterioration of the geopolitical environment, then flows could turn negatively quite quickly and abruptly, and so could asset price valuations in these segments. And then the question is, okay, what could this mean for euro area financial stability? And there we have 2 important strands that we think of and that we need to monitor. And the first is that due to the interconnection of financial markets, we could see spillovers from asset price deteriorations in stock markets, in US stock markets, also to key European stock markets, but also to European bond markets. And if that happens, we could see also a financial tightening for firms in Europe, and this would hurt their balance sheets and then also weaken their resilience to shocks. Then the other factor is more related to the exposure of the investors who are experiencing these valuation losses. As I said, this could go from the investment funds also indirectly then to the ultimate investors like households, but also insurers and pension funds could be affected. And due to these valuation losses, then would realize a wealth effect that could then also have second round effects on consumption and ultimately on the real economy. At the same time, maybe one let's say, relieving factor is that in particular in this stock market space and investment funds, the leverage levels are usually low. So these can be seen mostly as equity investors that should be able to also withstand a shock to some degree. And with this, I'm happy to conclude. Thanks.
Thanks, Christoph. A wealth of information and insights as usual from the ECB. We're very well in time, so I would like to open it up now for questions by the audience. Feel free to put in your questions in the Q&A. We already have a question which is reoccurring every year, which is, can you make the slides available? And I guess I can say, and correct me if I'm wrong, is that everything that you've presented is in the Financial Stability Review. All the graphs are there, so you can find all the information and much more there. And so usually we do not redistribute the slides more or further. Is that correct?
Yes, so I think everything that was in the presentations indeed is detailed in the Financial Stability Review of May.
Okay, very good. So then please have your questions coming in. In the meantime, I have a couple of maybe more clarifying questions, and I have two for Glenn and one for Christoph. So let me start maybe with Glenn. At some point in your presentation, you draw a relatively sharp distinction between private credit and leveraged loans. Is it always possible? Because you could very well have, certain leveraged loans that are also not traded publicly and arranged privately. So how do you make that distinction? Just because I think terminology in this opaque sector is really important. So I would like to know a little bit more how you can distinguish or how you did distinguish between these two. Because, also in the scenarios, they seem to be adding up in an important way, particularly with the banks being exposed very little to private credit, but a lot to leverage loans.
Yes, so therefore, so specifically for bank exposures, we rely on information collected by the supervisors, by the SSM on private credit exposures versus leveraged loans. So this doesn't, so there we rely on the fact that this is hopefully correctly reported, and more in general, it's definitely it's a very good point. So these markets are fairly opaque, and then so the way we try to differentiate is like in the other analysis that we make, we do not take into account here private credit exposures that come via or funds exposures necessarily that come via their participation in syndicated loan markets or things like that, which you might also have in mind. And plus the more aggregate numbers that we report in terms of private credit come from direct reporting by private credit funds. So here we making the assumption that these are private credit loans given that they're granted by private credit funds. But I agree that the distinction isn't always necessarily 100% clear. The only part where it is very clear is where we do the scenario analysis and where we rely on self-reported numbers from these financial institutions.
Okay, thanks a lot. And actually, on your very opening slide, you had something that you called dry powder. Now, that's not an accounting concept that I'm familiar with. So what do you mean? Net asset value, I understand, but what's dry powder?
So dry powder is basically the cash that they have at hand to still invest, these private credit funds. So typically, if you look at these databases like PitchBook and the like on assets under management of these funds, they make a distinction between money that's actually already invested, and dry powder is that money that they can easily ask from the investor to then actually
Okay.
invest, but that it is not invested yet. That is committed but not invested. Put it that
Okay.
way.
Okay. So I would potentially have to add these bars as you do it.
Yes.
Okay. Very good.
But then,
And
but
what, yeah.
but then again, around these, I mean, given that we were talking about opacity anyway, so on these numbers, like I said, it's given that these are very opaque markets, it's hard to get exact numbers on exact things like overall market size. And additionally, even when you have numbers available, there's very different ways of looking at the data. For example, here, these euro area numbers, as you can see in the footnote, is based on where the management team of the fund is being located. And then you get this 100 billion number for euro area exposures. If you would, instead of that, for example, look at funds domiciled in the euro area, then the number goes up to, I think, 250 or even 300 billion. So there's very different ways of looking at this data potentially. And one of the quote unquote, I think, problems at the moment is that there's no complete and very consistent definition and not a perfect view on how big and how exposed these types of credit are to certain sectors and the overall size of the sector.
Okay, and one more quick clarification question for Christoph, and then we move on. We have our first question in the Q&A. So Christoph, in your almost last slide with the one where you look at shock sensitivity, the left and the right graph, do they come from the same type of analysis, or they're two different type of analyses? I didn't fully understand.
Thanks. Yeah, this is actually coming from the very same model.
Okay.
So it's the same BVAR model, and on the left-hand side, we're estimating the effect to, technically speaking, one standard deviation shocks for these 5 different shocks. And then on the right-hand side, it's basically the historical decomposition for one of these 3 stock market categories. On the right-hand side is US equities overall, which reflects in the left-hand side chart the yellow one, the yellow bars.
But then I'm curious, because the US policy seems to be an important fact in the left-hand chart and has completely disappeared and is really only tiny or relatively small for a sub-period in the right-hand chart. So how do you square this? Are these different units or?
Yeah, I mean, the left-hand side shows you what would generally be the effect for a given US monetary tightening in this case. And on the right-hand side, that's about the actual occurrence of how many US
Okay,
tightenings were perceived in the markets. And I think therefore it's actually important to do this historical decomposition, because when one type of shock is hitting much more, it would also show up with a larger area, so to speak.
Okay. Okay, so enough from me. We have a first question from Ludwig Hehl, who says, we heard some big European insurers and banks had higher exposure to private credit. Do you know which firms? Are they systemically important firms, and are there some systemically important firms among them? Sorry for mixing this up. So, and also Glenn, you kind of alluded to this a little bit, not large, but concentrated. What more can you say?
Yes, so we for this special feature, we focused on, I mean, on the aggregate numbers for this analysis, while it is true that these exposures, they tend to be concentrated in more larger larger banks and some larger insurance companies, but we haven't delved into detail into these individual exposures any further, partly because there's fairly little information available out there on the exact exposures of these individual institutions.
Okay. And Christoph, if you want to add, then please feel free. Otherwise, I will move on to the next question. Dear all, referring to Christoph's analysis of current valuation risks, what impact would a decline in the value of European companies, equities, and bonds have on financing conditions and financial stability?
So just to check that I understood. So what impact decline in stock market valuations of European equities would have on the financing conditions of these firms, right?
I guess on general financing
Yeah,
conditions
yeah,
and financial stability, right? Is that something
yeah.
that, yeah.
Okay, thanks. Yeah, it's overall, of course, an adverse effect. I mean, to what extent, at which point this will become systemic is depends very much on the consequence, on the circumstances, let's say. But at the ECB, we wanna monitor different measures for financing conditions, and there are also stock market valuations alongside with bond credit spreads, long-term yields, and so on. They feature prominently, and yeah, I think the main or a big problem is that when stock market valuation drops for firms, this usually also has effects on other financing channels for these firms. So then at the same time, it can also become more difficult for these firms to obtain new bond financing. Maybe also some bank credit might become a bit tighter, given the value of the firm has shrunk. So that's by and large definitely an important factor that we need to consider and that matters. Yeah.
Okay, thanks, Christoph. Still waiting for some questions to come in. So there is by Tobias Berg. Thanks, both really interesting presentations. At Glenn, do you know why the private credit segment is so much larger in the US compared to Europe?
So that's a very good question. I think so. This is something, to be clear, that is not really part of the special feature. But I think if you look at how these markets have developed over the past 10, 15 years, there's a couple of potential drivers. One is private credit tends to be fairly closely related to private equity, in the sense that a lot of these private credit loans are used in so-called leveraged buyouts. So basically funding for highly leveraged takeovers by private equity entities. And if you look at growth in private equity markets, then you see that growth in private equity in the US was an order of magnitude larger than in Europe. So that could be one potential explanation, one potential driver there. Another one is if you look at the investor side, I think a lot of and there's a couple of reports on that out by now focusing on the US. So a lot of US insurance companies have been investing a lot in private credit over the past 10, 15 years or so, partially due to the fact that the capital requirements for these private credit exposures are a lot more beneficial for US insurance companies than for example, European insurance companies, which was also I think one of the drivers of growth in these markets. And then finally, and I'm not sure whether this really explains US and Euro area differences, but at least if you look at US markets, for US markets, there's been quite a number of studies by now, say more academic studies that focused on bank regulation as a driver of developments of private credit markets. So basically, credit shifting from banks to non-banks due to more tighter regulation. Of course, this trend in tightening of regulation is also something I think it's fair to say that we've also seen in Europe. So this is not necessarily something that can explain differences between both, but something that is often mentioned as a driver of private credit growth in the US.
Actually, can I follow up on that? Because that was something that I was curious about. It seems that the picture is solidifying that the risks of private credit are mostly concentrated in the insurance sector. And that's a bit puzzling. So why not banks? Why insurance? Is your answer that, oh, banks have now been regulated so well that it's unattractive for them, and insurance is lagging, the regulation of the insurance market is lagging behind? Or is there something else that makes it particularly attractive to insurance on both sides of the Atlantic than banks?
So I think two things that I think you still need to, there's still a big difference between these numbers for the euro area that we've seen in aggregate in terms of insurance exposures versus what you see for some US life insurers, where you see numbers up to like 25 or 30% of the balance sheet being invested in private credit, which really is a lot larger than for European entities. Aside from that, I think the reason why it's interesting from there is partially also the maturity match with their liability side. Like these are large illiquid investments, long-term investments that these loans that private credit funds provide. So this typically fits nicely with the long maturity exposures on the liability side of these insurance companies. So I think that's also part of the driver there, or the interest from this sector.
Okay. One more reminder to the audience: keep your questions coming in. If not, then let me actually, because I think in general, I think on both topics, right? I mean, on sort of the non-bank topic of Glenn and the sort of broadly valuation topic of Christoph, you hear really wide opinions, right? Some people say, "Oh, this is all very worrisome," and some people say, it's okay, it's still benign. And my feeling is that you're kind of coming out both a little bit more on the, it's kind of okay, we need to monitor, but it's not like catastrophic view. And for Christoph, then I would ask, well, there is the argument around that, yes, sure, there is not much leverage, and also applies to Glenn, there's not much leverage in this, but we could see huge wealth effects, particularly US, where a lot of personal wealth is invested in equities. And now if there are huge wealth effects, that could, as you say on the slide, it could also lead to consumption in the US. And the US is also a fiscally stretched country. So could this be a channel, sort of an indirect, why US fiscal position, a correction there? And once US government bonds reflect that risk, we really have serious issues. Is that something that you've thought about or that you worry about?
Thanks for bringing this up again. Yes, I think that's clearly what is behind, and what we could be concerned about. And I think it's also important that you highlight this in particular for the US, where stock market exposures, direct exposures, but also for pensions of US citizens depend much stronger on the stock market. So we also know from historical episodes that US consumers would be much more responsive to these wealth effects than maybe in Europe, where pension systems do not depend so much on that, and where in several countries also the overall stock exposures of the population is smaller. But yeah, these spillovers from the US, if we have a big demand shock in the US, this would of course also drag down on us. I would also not completely rule out any sizable wealth effects that would also drag down further on the European economy right now. And you also mentioned then the sovereign side and public debt levels, which are very high in the US, but which are of course also high in several parts of Europe and rising almost everywhere in advanced economies, which would then, of course, also limit the capacity for governments to step in case something like this happens and to stabilize the economy. So yeah, that's definitely a key channel one could be concerned about. But yeah, as I also I think mentioned in the presentation, at the same time, people investing in the stock market with their own money, with little leverage, should be aware this can happen, and therefore the amplifying effects on the rest of the financial system could be smaller than in case there's high leverage involved.
Okay, and in the meantime, there's one more, and I would suggest final question by Francisco. Given the very high and increasing exposures of EU investors to US markets, what would be the effects of a meaningful correction, e.g., minus 30% of stock markets for different categories of EU investors, notably banks and institutional investors? Who would like to tackle that?
Yeah, I guess it applies to a little bit to both of us. Maybe Glenn, if you can go back one slide. Thank you. And here we see these exposures to US stocks on the very right-hand side. I think one could easily do some calculations what this would mean for these different sectors. And as highlighted in the presentation, you would see that in particular non-bank investors would be exposed to such a valuation shock. So in particular, investment funds, pension funds, and households directly would be exposed from this shock. But the wider financial system, and in particular the banks, would not have like a direct exposure to that. So they could be still affected from any second round effects, but the direct effect of the stock valuation loss wouldn't be felt at the banks, which is reassuring, of course. So because it means that also their balance sheets, at least in the first round, wouldn't be hurt so much, and they could still maintain their lending to the economy. But yeah, Glenn, I think you even did further calculations.
Yeah, no. So overall, I think that kind of summarizes it very nicely, and that's very much in line what we've seen in the scenario analysis. That if you add this third layer, that for the institutions that we took into account, that it's indeed somewhat more would affect insurance companies, pension funds, and not so much the banking sector.
Okay, let me actually squeeze in one very last. This is really now the last question, but it's from Tatiana Farina, who is actually a colleague here at SAFE. So I'm a slightly bit biased and have a soft budget constraint on my colleagues here. I hope that's okay. We still have a bit of time. So she's asking concerning the relatively much larger investments in AI in the United States. If these investments ultimately generate substantial productivity gains, could Europe's main risk be not excessive exposure to AI, but insufficient exposure? How should central banks think about the financial stability implications of falling behind technologically?
Okay, so that's a very big picture question. I think I guess it partially relates to what we briefly mentioned in one of the slides on private credit being used for the AI build out, which seems to be happening more and more in the US. So basically the shift from private credit financing, like say so-called middle markets and medium-sized companies to really driving investment in these large-scale AI build-out projects. And I think to some extent I agree with that point, that that's a potential weakness if you have lack of credit available to finance this type of, say, technological revolution, if you want. And that's something, this is clearly the type of risk capital that is available in the US and which sometimes seems a bit harder to develop this kind of markets needed for that in the euro area. And that's also why at the end of my part of the presentation, I mean, and also in the special feature, we make this this point that while this feature itself is very much focused on risks, you always need to kind of make the trade-off and compare it to potential benefits that well-developed private credit markets could have, or investments in, I mean, we especially in innovation, but also in like technological developments and potentially very productive investments in things like AI. So from that perspective, I agree with that point that you need some credit providers to be able to stimulate this type of investments.
Maybe to quickly comment on this, I also fully agree that this is also a very serious risk. This falling behind, particularly when it means that growth is taking place in the US in these most innovative and advanced sectors and not here. And let's say from an not only central bank, but policy perspective in general, I think one can combine this with another call for these big buzzwords, savings and investment union, capital market union, because what this really means is, or what is behind is, we need a better integrated capital market in Europe, and to be able to finance also innovative firms here. And what you always hear and see is there is a very vibrant startup scene and highly innovative firms, but they do not get the proper funding to really grow big. And this is why so much of this innovation and growth is taking place in the US and not here. And I think this is clearly a policy priority. Maybe as a central bank, this is maybe not your main business, but the central bank will also feel the consequences, of course, when growth is low, with its implied effect on prices then.
Okay, with this big picture and slightly clouded outlook for Europe, but we won't give up. And I think
We shouldn't.
Thanks to the great work of the ECB in providing us with a wealth of data to have informed discussions, I would close the session here today. I would like to thank in particularly Glenn and Christoph for being available and sharing their insights, but also everyone behind the screens, the audience, for your questions and contributing to have a meaningful conversation here. And with that, I wish everybody a great rest of the day. See you soon. Bye-bye.
Thank you.
Thank you.
Bye.